We kick things off this Friday with a question. Is this that you see there the most important chart in the market? Consumer sentiment taking a nosedive in November, falling to its lowest level in a decade. You heard that right. Sentiment is lower right now than it was during the depths of the pandemic. Inflation seems to be the culprit. The University of Michigan Consumer Sentiment Survey showing 1 in 4 Americans are cutting back on their standard of living due to higher prices. So with stocks sitting near all-time highs, is the market ignoring some serious consumer concerns? Jeff Mills, what do you say?
Yeah, the market is definitely ignoring it. You know, we continue to push higher even though we get these readings. And I would say the most important chart is inflation because, as you said, that's really the derivation of all of these consumer concerns that we're having. But there's so much to try to figure out here. First of all, you have the Conference Board Consumer Sentiment Index or Consumer Confidence Index, and then you have the University of Michigan Sentiment Index. The Conference Board surveys 3,000 households, University of Michigan 500 households. So you get a little bit of a broader look from the Conference Board, and that really hasn't come down as much as University of Michigan. We'll get that in 2 weeks, so we'll see how things shake out there. But a lot of these confidence readings, too, they're at odds with retail sales data. They're at odds with millions of people quitting their jobs. So it's really hard to figure out exactly what's going on and what it means for the macro picture. But I'm going to go out on a limb here and say that as we sit here today, we're really at the peak of, inflation concerns, supply chain issues. Not that it's going to improve overnight, but I think incrementally the narrative is going to start to shift in that direction. I thought the news from Toyota was indicative of that. You're starting to see chip production in Taiwan increase a lot. The October delivery times for chips, it was the smallest gain that we saw in 9 months. So cracks in the supply chain is hurting us narrative. Ocean freight rates coming down, trucking rates coming down, dwell days, so containers just sitting around, that's coming down. So these are all very early signs, but I think the market may be looking toward those areas versus focusing on some of this consumer confidence data. And, you're seeing it in the market behavior. Small cap stocks breaking out, even pro risk from Bitcoin, SPACs, even a little bit better, things like that. So I think we're actually still setting up pretty good into the end of the year.
Into the end of the year, sure. I mean, we're in a period, Nadine, where, for the first time, Americans are going to be spending the holidays together, face to face. I don't think people are going to be holding back their credit cards or their wallets, on gifts this particular year. But looking at, unless those inflation concerns abate, you could see a sharp pullback in spending when the calendar page turns.
Well, I think you're right. I think Jeff makes a few good points here. Is that inflation, obviously, we're getting strong reads, but certain aspects of it are coming down. We're also talking about consumer confidence and sentiment. Obviously a little bit area concern, but related to inflation. But what I thought was most important coming into the week is implied volatility premiums. And what are those? It's kind of like the cost of protection. What we saw is that people had a lot of protection on coming into the week. They were paying up for that protection. So we knew that maybe we'd get a 3.5% downside versus upside. And that's what you saw, a really shallow early week decline. But then people are back in because that's really, people unwound some of that protection and that fuels the market back up. So we really look at what are those premiums being paid for protection, and they're still on there. People are still short. So there could be room for a continued melt up here.
Is that what you're seeing, Bonawyn?
In terms of implied volatility, I would argue I think it's actually coming in quite a bit. You see it in the VIX. You see it in some of the growth names as well. I think that's in line with what Nadine is getting at. And what happens is, from a supply-demand standpoint, when people have this protection on, you start to have some theta bleed. So you have some short-term holders that are going to be trading out of that, and they're going to have stops where they're going to have to let go of some stuff. And you have other people that are going to come in and scoop in when this implied volatility comes off. Net, what I'm saying is that ultimately the VIX is back towards normalized type of levels. I think it still has room down to about 12, but at mid-teens here, this doesn't seem overblown to me. In terms of sentiment and what I'm taking from the market, I would be a little bit cautious in terms of reading too much into it until I see the real trade through into consumer spending habits. Keep in mind that the consumer has been quite unlevered or delevered through this whole COVID situation. So, although there are concerns, and then parsing that data a bit further, you look at older and lower income individuals, you would always expect those constituents to be a bit more stretched when it comes to inflationary pressure. So all that being said, healthy market in tow. If you look at emerging markets, you're starting to see some rates tick up there, which is going to lead to influx in capital into the domestic market. So I think when you look at the global picture, matched with what we're seeing from consumer spending traits, I would be hesitant to try to short this market and break trend despite the negative sentiment reading.
No one is worried, Steve Grasso. No one. No, look the other way, say the other three. What do you say?
I was actually hoping I'd be the only one to say that I wasn't worried about it. But it looks like everyone, I have a bunch of company here. So
that's consensus.
It's true. But historically, a very blown out high reading on consumer sentiment is indicative of actual recession. Because when that peaks, you always have inflation that follows. So to Jeff's point, doesn't this help out with the supply chain woes or inflation concerns? I would say yes, it does. So if you're worried about the market, don't be on this. There's plenty of other things to be worried about with the market, thinking about it peaking or whatnot. But to Bonawyn's point, there's too much money that was shoved down the consumers' throats during this whole pandemic to make sure they didn't fail. So for us to worry about consumer sentiment now, I think it's probably too obvious when you look at that chart to think, oh my God, the market's going to fall out of bed now. It's counterintuitive, but when the consumer sentiment bottoms like this or hits rock bottom, it actually signifies a boom in the economy that's coming.
Contrarian indicator.